Hi folks, Chuck Gibson from Financial Perspectives with August 2018's Charts on the Move. The Dow and S&P 500 finished August up 2.1% and 3%, with their best performances for the month since 2014. The Nasdaq Composite clinched its best August since 2000, ending the month up over 5.7%. Most U.S. equity sectors have returned to, and in some cases exceeded, their January's all-time high. The trend is clearly higher, and several new momentum studies suggest that equities are likely to gain more into year-end. Recent macro and corporate results also support the ongoing equity bull market. While that is good news, it's likely higher prices won't be on a straight line. It's expected there will be the normal backing and filling. Despite the gains over the past 5 months, investor sentiment is not frothy. What is new is that U.S. equities have now a topping pattern in place. The momentum high in January has been followed by a price high in August. This is how every major top the past 40 years has started. On its own, it doesn't suggest a major top is near. But in January, not even a topping pattern was visible in U.S. stocks. That's no longer true, so we should continue with the strong trend, but like Jason Bourne, keep our eyes out for the closest exit in case the market has other plans for us. For those that like to look in the rearview mirror, the good news is that fundamentals behind the market, they continue to outperform expectations. Analysts' outlook were for the market to reach peak sales and earnings in Q2, with subsequent quarters rolling lower. It shouldn't come as any surprise that the analysts were wrong. Again, statistically, you're better off flipping a coin than following the analysts, as it would provide better accuracy. As you can see, with more than 98% of the companies having already reported, earnings grew 26.6%, exceeding last quarter's 25% growth. 81% of the companies exceeded their forecasted number. On the sales side, sales grew 10.4%, the best pace in years, and exceeded last quarter's 9.1% number. 75% of the companies beat their expectations. Great numbers all around. The takeaway is, so far, the economy is very healthy, not overheated, and most importantly, making new highs on all fronts. As you can see in my next chart of August futures performance, other than a few select commodities, U.S. stocks dominated the list of positive gainers. The Nasdaq was up almost 6%, small caps more than 5.3%, the S&P 500 just over 3%, while the Dow Industrials brought up the rear with just over 2.5%. Notice the majority of the list had negative returns. You don't have to look any further than this, the U.S. dollar. The negative correlation with other currencies, commodities, and foreign investments held true for the most part in August. There's something really interesting going on with U.S. stocks when compared to the rest of the world stock index. As you'd expect, with U.S. stocks leading the pack, the rest of the world should be lagging. But rarely, for extended periods of time, do U.S. equities move opposite direction than the aggregate of the rest of the world. When they move together. One may be rising or falling at a faster pace, but their movements are correlated. My next chart for the last 5 years up through May of this year of the U.S. S&P 500 index in green and the rest of the world stock ETF VEU is in red. If you stare long enough, you either go blind or you recognize that other than very short periods, typically less than a month's time, whether the index's stocks go up or down, they move in unison. If I extend the chart beyond May and through August, you will see the interesting thing that I'm referring to. As you can see, the S&P 500 index continues its strong move upward. At the same time, VEU is declining, making lower highs and lower lows. If I extend the time frame on the chart out to the inception of VEU, which is almost 10 years ago, that same movement unity between the two indexes stays true. There is one other extended period that may qualify as not moving in harmony. Here in April through July of 2015, VEU was falling, while the S&P 500, well, it wasn't rising, it was rather flat. Some may ignore or discount this as a negative correlation as I do, but I wanted to point it out. What this divergence in stock movement all means will probably not be known for months. The bottom line is that at some point, either U.S. stocks are going to find a top and follow the rest of the world, or the rest of the world will eventually reverse course and do a catch-up to U.S. stocks, providing a compelling investment opportunity. The $64,000 question is always, when? In case you're wondering, because of the strength of U.S. dollar-based assets, your portfolios are currently holding less than 10% exposure to foreign investments. This subjects us to short-term underperformance if the markets were to reverse course and see foreign assets begin to outperform. Looking out over the horizon, I definitely can see this happening, but probably not anytime soon. The flow of money out of Europe and Asia into US assets has some serious momentum behind it. Don't get me wrong, it's going to happen, but in my view, this current momentum has legs. Because long-term performance is number one, this is on our daily radar to track and monitor to ensure we don't get left behind when it finally does turn tail in the other direction. As you'd expect with August direction being higher, market sentiment is a bit overheated and needs to cool off before we can move materially higher. The fear and greed index is firmly in the greedy range, but not excessively so. The put to call ratio just recently moved into the bearish zone, but it's not at extremes either. The AAII investment survey shows optimism among individual investors reached its highest level, while pessimism fell to its lowest level since June. Knowing investor sentiment is a contrary indicator, but not a timing indicator. The current readings point to the need for some consolidation before we can expect the next move higher. Of course, it doesn't have to happen, but it would be more constructive if it did. With September being typically one of the weakest months, it would not surprise me if we see near-term pickup in volatility with downward price probing or, as a minimum, a sideways consolidation before we move on to new all-time highs in year-end. Drilling down to the next level and looking under the hood at what were the drivers of U.S. stock performance, we see the results of that in my next chart. The almighty consumer was in beast mode as the retail sector was up almost 9% for the month, followed by that breakout that happened in biotech, which ended up the month more than 5.5%. And the tech-heavy NASDAQ 100 was up 5.25%. Everything else lagged the 3% rise in the broader market S&P 500. Those three sectors mentioned did the heavy lifting. I'm going to end this month with a look at the US dollar index. I know how some of you can't go a month without knowing about Uncle Buck, so I don't want to disappoint. Seriously, it continues to be the driver of so many other investments that figuring out what the probabilities of its next move could obviously provide some helpful insight as to what we can likely expect from those other investments. As you can see, we're at a critical juncture here. Pulling up the chart, hopefully your eyes are drawn immediately to that inverse head and shoulders bottoming pattern. It broke out of it during the first week in August, powered strongly higher the following week, printed a shooting star reversal pattern, then closed out August, backtesting the breakout level. Those that follow regularly know that breakouts are frequently followed by a quick reversal to retest the breakout level, which becomes support. There are really only two possibilities here. The first one is a bounce off support, putting the dollar back on a path to retest 2017's highs. The implications of this are ongoing strength in dollar-denominated assets, including stocks and bonds and possibly even real estate. The good news is it will not require a change in current client portfolio positioning, as we are heavily oriented this way. On the other hand, if support fails, creating a false breakout, it would be expected the dollar to fall, likely precipitously, back down to early 2017's lows. The implications, of course, would be a strong rally in foreign assets, commodities, and maybe even see the left-for-dead precious metals complex participate. That would necessitate a shift in client portfolios to help reposition into strength. As you know, I've been bullish the dollar since its breakout in 2014. I still believe, because of all the financial headwinds around the world, the dollar will prevail. No, I don't think it will last forever. In fact, looking long term, I expect the dollar to eventually lose its status as the world's reserve currency, but that's likely many years or decades off in the future. Until next month, as always, I appreciate your time and your attention and hope you found this video informative and helpful. If you have any special requests for the next installment or comments, I'd love to hear from you. You can send me an email at chuck@financialperspectives.biz. Again, thanks for listening, and until next month, this has been Chuck Gibson from Financial Perspectives with August 2018's Charts on the Move.